Welcome to this episode of the Capitalist Investor. We have Tony the Tiger.
Yeah.
You have Cool Hand Luke, me, and Derek is on assignment. Well, we had tornadoes rip through Cleveland.
Yeah. If you're not from
survive?
the area, we got blasted on Tuesday. Lost power in the office for a couple days, but you know what? We're here battling. We're trying to get this information out to you guys and get our podcast cranked through. And our first, topic back in the streets here would be
Back in the streets. We're talking about a very nerdy subject, something called the reverse carry trade.
Yeah, but the markets are in turmoil.
The markets are in turmoil.
And one of the underlying thesis behind this is what is called the reverse carry trade.
Yes. So
right,
big
so
focus you
explain
hear on the news right now is what's happening over in Japan. And most people are like, why would I care about Japan? Well, the reason you would care about Japan is you think debt issues are bad here in America at 120% debt to GDP. Japan's is like 3 times as worse. They're like 300% debt to GDP with the amount of debt they've taken out as a country. What's interesting is not just them as a country is taking out debt. The whole world's taking out debt from Japan.
Right. But Japan has had zero interest rates for 20 plus years,
which has fueled the debt.
And some of them have been negative.
Right.
Like they were, you put money in there and like that's
you got to pay. You got to pay money.
You got to pay money to put money away.
You got to pay the bank to store your money.
That's how bad it was, right?
Right.
So, and for years and years and years they've done this. Well, Japan just recently hiked rates for the first time in 20 or 25 years.
Yep. And they only did it 0.25%.
0.25%, yep. Right? But now you have the rest of the world who has been working a little bit more normally, is what I'll call it, where they
organically.
They hike and they hike rates and they decrease rates based on what's happening on, their macroeconomic situation, right? COVID hit, slash interest rates. Inflation goes up, hike interest rate. We heave with the changes. Yep. So what a reverse carry trade is basically an arbitrage move.
Yep.
So we kind of set the stage already where Japan is essentially at 0%. They went to 0.25, and the United States is, we'll call it 5, plus a quarter, half quarter, whatever it might be. But let's just call it 5 to keep the math simple. People are out there leveraging the difference between this gap. Well, when the gap was 5 to 0, 5% on the U.S. side and 0 on Japan, people are operating based on that'll never change. Yep. And then when the Bank of Japan came out and quote unquote squeezed it by 0.25%, created this mess.
I could not have explained that any better.
Is that right?
You killed that.
I mean, yeah.
So that's exactly what's happening, the arbitrage thing. And what's interesting is the number that's being thrown out. There's like $20 trillion.
Oh, there's so much money. The reason it went through and wiped out $1 trillion of market cap or whatever.
Yep.
Is because there's 20 trillion on the line, and when you move 0.25% on $20 trillion, guess what? That's a lot of money. That's a lot of money. It's $1 trillion.
It's a lot of money.
It's $1 trillion.
It's a lot of money.
It's like $500 million.
It's like $100 billion. Yeah, whatever it be, or
I don't.
Something like that.
I'm not a math guy,
math magician over here. But no, seriously.
But that's what happened.
It's a lot of money that you have to take out of the global world. Because we don't operate, we just don't operate in the U.S. We operate in the global scale, and that's why you saw Japan, and I think it's the Nike, whatever, 225. It was down 11%. Like, what was it, Monday or Friday last week? It was down 11% in one day because of this reverse carry trade. Yeah. Then it rebounded 7% the day after.
So now we can sit here and say this might not be over.
Yeah.
That markets in turmoil it was in turmoil. That does not mean it's over, because what is happening is we, the United States, are talking about cutting rates.
Yep.
So there is a more squeeze, right? We're not going to be at 5 anymore. We're going to be at 4.5 or 4 3/4, whatever it may be. The squeeze will continue.
That's right.
And if we go down 2%, imagine what that's going to do. Like, what if we get to 3 over the course of the next 6 months.
Well, what's it do to
every time
US dollar too?
every time they decrease the rate, are we going to have market whatever? Because they're decreasing the rates because our economics are messed up.
Right.
Unemployment's creeping up. Inflation. Well, thank God inflation's been flat, but economic data is starting to waver a little bit. Is what I'll call it. It's not bad by any means, but it's wavering.
So it's also interesting when it comes to the U.S. dollar, the currencies. So the strength of currencies, the higher your rates are, the stronger your currency, because other countries want to invest in your debt. So when rates go from 0 to 5% like they did in the U.S., it makes the U.S. dollar stronger. When they go lower, though, when rates go lower, it makes the U.S. dollar weaker. So when you kind of mentioned, you have the Japan now getting stronger. The yen is getting stronger against the U.S. dollar.
Right.
And when you have a weak U.S. dollar, it also begs the question, what's good from an investment standpoint? So, strong U.S. dollar is usually good for domestic stocks. I think a weaker dollar is good for international stocks. So it's interesting how you start looking at the allocation in your portfolio, and that's one of the reasons why we own India, Mexico. We're starting to look internationally for spots out there to take advantage from if the U.S. dollar gets weaker.
Right. So,
how's this end, Tony? Just more global turmoil?
It's going to, I mentioned it a few moments ago. If this was created by 1/4% increase by Japan, what happens when we, again, United States, decrease by 1/4 or 1/2? Mm-hmm. Because they're already talking like, oh man, you never know. The Fed might have an emergency meeting and cut before the next thing. That'd be the most, you and I had a side conversation before, like that would be the most like messed up thing you can possibly do. Yeah. Like you got Powell coming in being so dovish for so long, and then they're just gonna. There's no way. I would put the probability of something like that at 1%.
Yeah.
I'm not leaving it out of the realm of possibilities because you never know what could happen next week or whatever. I mean, we got to get till September, and we just started August, right? So I don't know. How do you think it ends?
Well, again, not to be more pessimistic or things, because at the end of the day, pessimism doesn't drive money. Optimism drives money and makes money. But I will say that I do think we've been living in this fairy tale, I've talked about it before, world too long, where this debt cycle does go boom eventually. Japan could be the start of the bursting bubbles of the debt cycle. Too much leverage is out there that's going to get wiped out. The question then becomes, where does it get wiped out? Does it get wiped out in treasuries? Does it get wiped out in bonds, junk? Where does it get wiped out? And I think that you'll see the clearing of the froth. I think the federal, I said this on, I did FinTech TV for the first time. It's like a little small network that's hosted at this NASDAQ or stock exchange. And one of the things I said in there is the Federal Reserve is doing exactly what they were designed to do. It's good for two things: bailing out things and bursting things and breaking things. And right now we're going through the breaking cycle of what they're good at. And this is exactly what they wanted to see with things breaking. They wanted to see unemployment rise. They wanted to see...
They had to break
They wanted to see the froth get wiped out. They wanted to see companies that should never have existed get wiped out. Like, this is actually...
You're right. This was designed... This should have been designed this way.
But this also then goes back to my philosophy. Are the free markets really free? Like, they're not free. We don't live in a free market system. Like, Japan literally said, I retweeted this or quoted, I said, are the markets really free? And the quoted tweet, or X, whatever you want to call it, was that Japan says they're not going to raise rates when markets are down, or the markets are in turmoil per se, something like that. Like, is that really a free market when you have a Federal Reserve saying they're going to lower rates or hike rates based on market reactions and what's going on? Like, that's not a free market. So we live in a completely fraudulent, socialistic world.
But Powell said this is not. He does not base it off of the market.
Powell don't, but the Bank of Japan came out on that, and also that's a lie too. I don't believe.
Yeah, I mean that's what he says, and what he says and what he does can obviously be the same thing. But I've had a lot of people asking like, "Well, dude, is this it?" Everyone's waiting around. Is this it? Is this it? Right? Is this the drop? Is this the crash? Is this the bubbles popping?
Yes.
Right? And it's amazing to me of the talking heads that are on TV, chirping, but especially the bulls. Yeah. Like, man, this market, the S&P could be at 6,200. You slap 6,200 on where we're at right now, and we're looking at 20% plus, 20 to 25 from here. Mm-hmm. And, like the thesis behind that is supposedly, You know, there's $6 trillion sitting in money market type of accounts, in 401ks and, bank accounts, CDs, things like that, just safe, quote unquote, safe income.
Yep.
When does this 6% get deployed? I don't know what happened this week. I know that the hiccup happened earlier this week. I don't know if they, how much of that has been wiped out. But I know I got a couple clients kind of involved back again because they were waiting for something like this, and it bounced back. It's already back. So
well,
I don't know, man. I don't know where the
is it a bear market?
Happens.
Yeah, the question is it a bear market bounce, or is this actually just there's a bottom in? The question you have to ask, right?
I mean,
and how long?
Think of
is
a pressure cooker, man. And things pressure cooked since last August.
Yeah,
2023 August, or I'm sorry, October was the bottom. I looked at that. It was like at 440. Let's call it $4,000, or the S&P was at 4,000, and we're at 5. We're up 25 to 35% since the bottom of last October.
Yeah.
It hasn't gone down since then. It's gone straight up with a little minus here and there. This was the biggest, quote unquote. It was a correction for a week, and poof, we're back to moving.
Well, now you have bond yields coming down. So I have actually been talking to clients and people. That 5%
bond yields have then corrected then.
A little bit. They went from 4.3 on the 10-year down to 3.7 at the low. I think they're probably back to 3.9 now.
They're up 4.
They're at 4.
Yeah.
They correct a little bit, but still dropping from 4.3 to 4. That's still a big move.
Yeah.
So I mean, the question is,
yield goes up. That means assets are being sold.
Right, but my point is still it's below than 4.3. Wow. So the 5% that people are earning in their savings account or 4.5%, that's going to go lower.
It will.
So
eventually.
A year from now, when you're earning 2% in your bank account, then you have to look elsewhere to make a return.
Yeah.
So that's where money starts flowing to the markets, and that's the question is, where do you allocate money? So I have clients that, over the past 6 months I've brought on, and I'm like, well, let's get a dollar cost average strategy going so we can get you into the market slowly. But also, like, I'm not in a rush. If you're used to being in cash and you have $500,000 in cash, it's never been invested in your life.
Yeah.
Like, I'm not in a huge rush to get that money to work when it's earning 5%. But I'm like, I called them up actually this week when bonds dropped from 4.3 to 3.8. I'm like, yield's going to be coming down probably over the next 6 months. We probably should get a little bit more aggressive with getting some more money to work as that yield comes down. So it's something you got to think about from a portfolio standpoint.
Yep.
All
so I think that's it, man.
We are rocking our first podcast a little late this week because the storm and our power was out here at the office. But tune on in next week to our next two.
I don't know if it's even next week. I think it's just
Monday and
days.
Wednesday, I think, right?
I don't know. We got to expedite a few things, so we'll see.
Thanks for tuning in, guys. The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.